Canada has a month-long reprieve from U.S. President Trump's plan to enact 25% tariffs on almost all Canadian goods. But with plenty of uncertainty on where things go from here, how should investors be thinking about the potential risks to the TSX? Joining us now to discuss is Michael O'Brien, Managing Director, Portfolio Manager, and Head of the Core Canadian Equity Team with TD Asset Management. And Michael, thanks very much for joining. And as I mentioned, there is a pause on tariffs, but we're still not out of the woods yet. So how does the tariff saga change your base case for the Canadian markets?
Okay, thanks for having me on, Anthony. It's always fun to come on. So yeah, yesterday was one for the record books, huh? It was a pretty high drama day.
A lot of uncertainty, a lot of volatility.
Yeah, and I mean, it's interesting. You could ask the question, what did we learn from that? And I think what's interesting is different people are going to draw different conclusions. I think the folks who were in the camp all along that, no, President Trump is going to do a lot of good things on taxes and deregulation, and forget about that tariff stuff. He doesn't really mean it. I think they got a shot across the bow yesterday morning, but they might actually be emboldened by this and say, see, there are no tariffs today. He pulled back at the last second. Myself, I think that's the wrong lesson to draw from yesterday. He and his inner circle are throwing their weight around globally, trying to see, how far they can push the limits in many different directions. To me, I think this has to force us to take a little more realistic view of the pros and cons of what a Trump administration really means for financial markets, and particularly non-American financial markets. What I think I learned from yesterday is this is a fragile or I should say not fragile, volatile situation, and I think that behooves all of us. As portfolio managers managing your own investments, to take a more balanced or more nuanced view of what the most likely path forward is. I think, a lot of us wanted to believe coming into 2025 that, this year was kind of a one-way bet higher on stocks. I think what we're seeing with, not only yesterday's shenanigans, but also the previous week with the DeepSeek sort of mini market crash, the previous Monday. Markets can move very quickly in both ways. And so I think to the extent that my base case or my outlook for the year is changing, it's going from something that would have been along the lines of lots of things that can happen, but the path of least resistance is higher, good things should happen. I think now I'm looking at this much more level-headed and saying, there are good things and bad things that are going to happen, but the only thing I know for sure is that it's going to be a very volatile, bumpy ride.
Okay, so when we look at the sort of that path forward, let's discuss how that tariff threat and what impact it could have on some of the sectors. Why don't we start with financials? Yeah,
I mean, obviously financials are the bedrock of the Canadian market. And they are also, if you really think about the function, particularly the banks, it's been said many times, it bears repeating, banks are a levered play on the Canadian economy. What affects the Canadian economy is going to translate, right through bank P&Ls. So when you look at the threat of tariffs, and they almost became a reality 24 hours ago, they may still become a reality 30 days hence. What that really means is, coming into 2025, the banks had a really nice move higher in the back half of last year. And that was built upon a notion that the credit cycle was largely behind us. The economy would gradually improve. Loan losses would begin to roll, to fall. And that would lead to stronger earnings growth in 2025 and especially 2026. The shot across the bow yesterday on tariffs is, if tariffs do go into effect, as you saw, some pretty dire consequences in terms of the impact on the Canadian economy. In a worst case scenario, what that means is all of a sudden now you're unwinding that credit moderating thesis. It's, oh my goodness, maybe we're going to have more loan losses next, not less. So in that sense, it'd be one thing if these banks were trading at 9 times earnings. The fact is that their valuations did recover in the back half of the year. And so we kind of need good things to happen if we're going to get big upside. So, that would be one particular part of the market. I would say, this has exposed, a vulnerability. Things have to go right for these stocks to work. And if they don't, they're no longer priced in a forgiving manner.
Okay, now there are other sectors that are also vulnerable to U.S. trade. Why don't we talk about those sectors that could be impacted more negatively from the tariffs? Rails, maybe we could talk about rails and oil and gas.
Yeah, and again, it's kind of a binary conversation we're having here, and obviously, most of the times life isn't binary. There's always somewhere in between. But if you get 25% tariffs, and you saw this in the market reaction yesterday in the early part of the trading day before the reprieve was granted, some of these more cyclical areas in the market really sold off hard. And so the rails are a great example. CP Rail, it's long been a core holding of ours, but the fact is that 40% of their revenue come from cross-border trade between Canada, the US, and Mexico, kind of on the front line of it. And so what you saw was when investors were negatively surprised about the potential 25% across the board tariff, this was one of those names, a very high quality name that sold off hard on reaction to that news. Now it's gained most of that back today, but that's an obvious example. The oil and gas sector, it's kind of a fascinating one because it's hard to just draw a clear conclusion. One argument that has been made repeatedly, including by myself, is contrary to what President Trump might claim, the U.S. does need Canadian oil and gas. And a lot of people would point to the fact that he carved out a partial exemption for Canadian energy products in the initial 25% shot. Instead, it was going to be 10% for oil and gas. I think to a lot of people that sort of showed that, yes, he does realize Canadian oil and gas is integral to North American energy dominance, would be the better way to put it. That said, within that space, names that are reliant on, potentially tariffed barrels going into the U.S. were hit harder than the names which have, for example, downstream refining assets in Canada, relatively more protected. And they stood up, or they struggled more than the names like your pipeline and midstream companies, which have more contracted revenues. So, you clearly saw that rippling through the sector. Different degrees of impact, but no matter how you cut it, not good if you get 25 or even 10% tariffs. So,
are there sectors that might be more insulated from those tariffs? What are your thoughts there?
Yeah, I mean, there are always pockets that have relatively less exposure. And, in this case, a lot of them are the traditionally more defensive parts of the market or more interest rate sensitive parts of the market. Names like, for example, your regulated utilities. You think about your regulated utilities, not only are they, interest sensitives with relatively economically insensitive business models, they're basically regulated earnings. They're also, a lot of them have big U.S. footprints where, they're earning a lot of their, their revenue and their profits in U.S. dollars. That's not a bad place to be in a world where the Canadian, where the loonie is down in the, 68, 69 cent level. So, that would be one obvious example of a relatively protected space that actually benefits from the Canadian currency weakness.